Every investor faces the same big question. How do you know if a stock is a fantastic deal or just ridiculously overpriced? It's a huge deal. Get it right, and you could do really well. Get it wrong, and, well, it can really hurt. So in this explainer, we're going to break down two key tools that'll help you tell the difference.
Right. This is the question that can literally make or break your investment. So you find a company you really believe in, but how in the world do you decide if the price is right? Answering that question, well, it all starts with having the right tools in your toolkit.
And the most basic tool in that kit is the price to earnings ratio, or PE. Just think of it like a stock's price tag. It tells you exactly how much investors are willing to pay for every single dollar of a company's earnings. Now, a high PE could mean people are expecting big growth, while a low PE might signal a bargain. But here's where it gets interesting. There isn't just one PE. There are actually two totally different ways to read this price tag.
So first up, let's look in the rearview mirror. We're talking about the trailing PE. This is all about sizing up a company based on what it's actually done, its proven historical performance. Here's how it works, and it's pretty simple. You just take the company's current stock price and divide it by the earnings per share it actually made over the last year. This is the standard PE you'll see on most financial websites, mainly because it's grounded in cold, hard facts. And right away, you can see the trade-off here. The biggest pro of the trailing PE is that it's reliable. It's based on facts, not someone's guess. But the downside is a big one. What a company did in the past is absolutely no guarantee of what it's going to do in the future. Okay, but since investing is all about the future, right? We also need to look through the windshield. And that brings us to the forward PE. This metric totally flips the script. It's all about valuing a company based on its potential. It asks the question, where is this company headed? So instead of using past earnings, the forward PE uses projected earnings for the next 12 months. These are just estimates, usually coming from financial analysts or sometimes even the company itself. It's basically a forecast of what they think is coming. And this has its own set of pros and cons. A lot of investors love the forward PE because, hey, investing is about the future. But the problem? It's all built on estimates. And those estimates, they can be biased, way too optimistic, or sometimes just flat out wrong. Okay, enough with the theory. Let's see how these two ratios actually work in the real world. We'll analyze a hypothetical company. We'll just call it Company XYZ. All right, let's say Company XYZ stock is currently trading for $53 a share. This is our starting point. It's the P in our PE ratio. Simple enough. Now for the E, the earnings part. If we look back over the past 12 months, the company's actual earnings per share, or EPS, was $3.44. This is our historical fact. This is what really happened. So let's do the math. We take that $53 stock price and we divide it by the historical earnings of $3.44. And that gives us a trailing PE of 15.4. You can think of it this way. Investors are paying about $15.50 for every $1 of past profit. That's the price tag based on its proven track record. But wait. Company XYZ has been investing in some new projects, and they think profits are about to shoot up. So analysts are projecting that its earnings per share over the next 12 months will be $4.77. Notice how that's a lot higher than the old number? Now, let's run the numbers for the forward PE. We take that same $53 stock price, but this time we divide it by the projected future earnings of $4.77. And the result? A much lower forward PE of 11.1. So all of a sudden, when you look at it through the lens of its future potential, the stock looks way cheaper. And this, right here, is the key insight when you put them side by side. The fact that the trailing PE is up at 15.4 and the forward PE is down at 11.1, well, that suggests the market is expecting earnings to grow and grow significantly. For an investor focused on growth, this could make the stock look like a really attractive deal. So you've got the past versus the future. Which one's better? Well, the verdict isn't really about picking a winner. It's about knowing which tool to use and when to use it. Let's just break it down nice and simple. The trailing PE, it uses historical facts to figure out a company's current value. It answers the question, what's it worth right now? The forward PE, it uses future estimates to get a sense of potential growth. It asks, what could it be worth down the road? One's about stability, the other's all about potential.
So here it is in a nutshell. For the trailing PE, you're getting the reliability of actual past results. But you gotta remember, the past doesn't predict the future. With the forward PE, you get that exciting forward-looking perspective, but you're really betting on estimates that could easily be wrong.
So, what's the bottom line here? It's that neither of these ratios is better than the other. A smart investor doesn't just pick one and ignore the other. Instead, they use both. Think of them as two different lenses that, when you use them together, bring a stock's true story and its potential value into much sharper focus.
And that really brings us to the final question I want you to think about. When you put your money into a stock, what are you really betting on? A company's proven past or its promising future? Understanding these two ratios is really the first step to answering that question for yourself.